We start with a big reversal for stocks today. The Dow swinging more than 300 points as the bond market continues to wreak havoc on Wall Street. The 10-year yield sinking to its lowest level in 14 months as the yield curve continues to flatten. Even the bond proxy sectors like utilities falling today. So should you shake off the growth fears? And what is safe to buy? Guy.
Well, again, welcome back. Day 2 of this week. I know you're playing hurt, so kudos to you.
Thanks for looking out.
No, I'm pointing it out. So are the growth fears overblown? Well, we talk about them a lot, but are they overblown? Well, no, not at a VIX at 15, and not when the S&P 500 within 4% of the all-time high we made back this fall. So I think although they're talked a lot about, the market doesn't seem all that concerned yet. But what I will say is this. The fact that we continue to sort of seem to roll over at this 2,800 level has to be somewhat concerning. I think the VIX is too cheap given this environment, and I do think stocks come under some pressure. With that said, to answer your original question, I still think you can buy. What was that?
It's about time.
He's playing hurt, but he's waiting for an answer.
He's still got it.
I'm not that hurt. Obviously not that hurt.
And I think Tim would agree with me on this one. I still think energy could be bought in specific areas, big cap energy, ExxonMobil. I think some of the names Tim mentioned the other day, Devon and Cabot Oil, for example, is a buy. And I still think healthcare goes higher from here.
So I would agree with that, and I would just take my glass half full to the half empty. What's going on with the 10-year also may be some of this. Today's news, not the entire move in the 10-year. Obviously, we've been wrestling with growth fears, but Stephen Moore, do we have a loose cannon? The Fed wants to cut rates. The rumor's out there, another 50 basis point cut. There's no question.
Not a rumor, he said it.
Well, okay, but the rumor that the Fed would actually go through and do this, you're right. I mean, people are contemplating whether the Fed cuts once or twice. The fact that we're even doing that is very different than we were a month ago. The things I'm encouraged about, first of all, today's trade data indicated exports were not only up, but they were up significantly to Europe. For everybody that's looking for a rebound and at least some response to, hey, I think we're through the worst of the growth fears, I think that's something. Some of the risk indicators you could be looking at. Dollar yen acts fine. U.S. leveraged loan index acts fine. U.S. high yield acts fine. The places where you really get concerned, emerging markets and semis have been battered over the last 5 days. And I think you could pay caution there.
Sorry, Dan, as long as rates, though, remain low and at the top of the conversation, doesn't it put somewhat of a cap on the rally?
It might do, but I think at this stage of the game, with rates going the way they are, from the 10-year yield above 3.25 just 6 months ago to where it is, it looks like it's going back to 2%. That's not particularly bullish in my mind.
Of course it's not.
No, okay, so he asked me, not you.
Sorry.
He's the one who asked the question.
But
here's one thing I want.
So
can I make my next point? So the last time we had this situation was late 2015, early 2016, and we really did have a serious global growth fear about deflation, about rates just going there. This is when we started to see a lot of sovereign debt go negative around the world. And what outperformed here in the U.S.? It was these things with strong secular trends. It was the MAGA trade. You guys call it FANG. It was also a lot of these cloud names. But I think it's a different period right now because I'm looking at Adobe, I'm looking at Salesforce right now. They don't have the outperformance relative to the NASDAQ that they did once, just a couple of years ago. So I guess my point is one thing to say high growth, secular trends, this is fantastic, but here we are a couple years out from the last time we had that sort of scare. I'm not sure the valuations make a whole heck of a lot of sense in some of those names right now.
I think what you're doing is you're always looking for quality. That's where everybody starts, right? But when you look at the interest rates and you look at where we were over 3%, here we are at 2.4% or a little bit below that even. So what does that mean? It means the multiple increases and what you can do in terms of the market itself. And I think you look at names right now that you look for quality, and the first ones you look for quality, you look for free cash flows, and then all of a sudden you look at dividend yield and some of the rest
of them. Give me some of them then. Where is the
quality? Give you a great list. I'll give you, I looked through my list just now of what I own stock-wise, Scott, and almost all of those fell in the category of they have growth, they've got a dividend yield, they've got quality. Target, Home Depot, Lowe's. You go through that list, and KMI, Kinder Morgan. So you're still exposed somewhat to energy, but it's not so much based on just price.
But Home Depot and Lowe's, though, are exposed to a slower economy.
They are
the housing
exposed,
market.
They're exposed to that if you believe
weak.
that. If you believe, I mean, we are weakening a little bit, I think, in the economy. But are we slowing to a stop? No. Do I think the spring season is going to be strong? Yes. I still think we're going to see the Home Depots and Lowe's outperform.
I think there's major defense for Home Depot, at least in an environment where people are less, optimistic about what might be going on in the economy. Because frankly, people are going to be fixing up their homes. They have jobs. Interest rates are low. I think they're going to be spending money on their houses. I also think that Home Depot has proven to at least have some counter-cyclicality to it. You talk about free cash flow yields. Look at the energy sector again. Chevron has never had better free cash flow yields, and I think that's something to think about. Nike. great free cash flow yields. Apple, great free cash flow yields. So, yes, I agree, and I agree with those names that Pete talked about. Those are high-quality companies here, and the world is not falling apart overnight. And I think as much as we want to believe that that could be the case based upon a bond market move that's dramatic and scary, it's not what's happening.
It's not like
right
the
now.
data overseas, though, the bond market here is robust. I mean,
it's not robust.
These economies, whether it's Germany and other places around the world, are undoubtedly slowing.
They are undoubtedly slowly, and we can make an argument that Germany is first of the major European economies to go into recession. We're going to have a lot of data tomorrow morning. Look at CPIs out of Europe, especially Germany, and you also get European confidence. But again, I am encouraged by, if we think that the trade war was essentially a supply-side issue, you should get a V-shaped recovery if we think that the trade war is gone. I mean, do you guys believe that if we didn't have the trade war, the economy would be in the same place it is right now?
But the point is, no.
The question is, how much better, if it was better, would it really be?
Okay.
That's the thing.
Yeah, I mean, but
you're saying you get a V? Well, I don't know. Maybe the V starts up, but then it stalls because earnings are still not going to be all that great.
Yeah, the best case scenario, though, we have an S&P 500 that's up 12% on the year. Now, obviously, it's where it was just 7 months ago, so we actually did have a V recovery in the stock market, but we're still well below those prior highs, and we've been in an 18-month range. I'd say the best case scenario now is the idea of thinking about how does the second half look if we do have some sort of trade deal in the early summer, because that's the trade that you really want to get on here, and you'd like to see the stock market actually pull back, right? You'd like to see sentiment get a bit worse than it is right now. You'd like to see when Q2 guidance comes out in April, you'd like to see it somewhat downbeat without a whole heck of a lot of clarity, because that's a market you want to buy for what is most certainly going to be some sort of deal for the second half of the year.
I know we all pay attention to the S&P 500 in terms of where's it going now. It's up whatever you just said, 12%, whatever it might be right now. But don't we look at the whole rotation of what's going on in the market as well? I mean, we're looking for the sectors and the segments in which we want to be, right? I mean, we're always moving. Semiconductors, you just mentioned, have had a dramatic pullback from where they were. They were screaming up, and now we've got a little bit of a pullback. Does that mean it's over for the semis? I don't think so, but I think you just got to go through each and every one of these and just figure out where the rotations are, be very nimble. And again, and Scott and I were talking about this at noon, it's a trading market. This continues to be very much a trading market, and even the big boys are trading this market, and I think that's why we're seeing these moves where we're seeing swings once again, up 200, down 200 in the same day. That's because it's trading.